Causes of foreign exchange rate fluctuations. Why is the exchange rate not stable? Who is responsible for the fluctuations? The citizens blame the government. The government blames the citizens. The politician blames the big corporations. The blame game continues. This lesson will explain clearly the real causes of currency volatility. The currency's value in terms of other currencies, the exchange rate, changes from time to time. The major causes of these fluctuations are the forces of demand and supply. Demanding the currency means buying the currency. For example, if a foreigner wants to buy goods from a country, he has to buy that country's currency. To supply a currency means to sell it. The citizens sell their domestic currency or exchange it for foreign currency whenever they want to pay for their imports. Consumers are the ones that demand for things. Producers offer things for sale. The actions of millions of consumers and producers in the economy will affect the exchange rate. Even the activities of foreigners can cause volatility in a country's exchange rate. Therefore, everyone is to blame for currency volatility. Our actions either affect the demand for a currency or the supply of the currency. Let us consider the effect of supply on the exchange rate. A rise in importation will increase the supply of the domestic currency because people sell their currency or exchange it with the currency of the exporting country. In the diagram, supply increases from S1 to S2, and the exchange rate decreases from P1 to P2. Assuming the UK has a good and attractive economy, a lot of people would want to relocate to the UK. But they are not going to spend their currencies in the UK. The UK sellers only accept the pound. The prospective immigrants would have to buy the UK currency while selling their own so that they can spend in the UK. There will be an increase in the demand for the pound sterling, raising its value. As shown in the diagram, the demand increases from D1 to D2, pushing the UK's currency value higher from P1 to P2. The major causes of exchange rate fluctuations are demand and supply, but there are certain factors that affect them. These factors include higher demand for imports by the country's citizens, higher demand for a country's exports, relative interest rate, relative inflation rate, attractive investment opportunities, and speculation by currency traders. The first factor is higher demand for imports by the country's citizens. A country's residents will have to exchange their domestic currency for foreign currency to pay for imports. That means they are selling the domestic currency. This will increase the supply of the currency, which will cause a fall in the value of the currency. Higher demand for a country's exports. If a country's products are competitive in terms of price and quality, foreigners will demand more of those products. A rise in the demand for a country's exports will make foreigners buy the country's currency to pay for its products. This increases demand for the domestic currency. An increase in demand for a currency will raise the value of that currency. Relative interest rate. This is the interest rate in a country compared to the interest rate in another country. A rise in the interest rate in the UK, for example, means that the reward for saving money in UK banks has increased. This will attract bank deposits from residents of other countries with lower interest rates, but they will need to change their money to pound sterling before bringing it into the UK. That is, they will need to buy the UK pound. This increases the demand for the UK currency, thereby raising its value. Relative inflation rate. The inflation rate affects the purchasing power of people's incomes. A rising inflation rate means that people can only afford fewer goods because prices have risen. The inflation rate of a country compared to other countries affects its exchange rate. Assuming the inflation rate in the UK has risen to 13%, but that of Spain remains at 8%, it will be costlier to live in the UK compared to Spain. Consequently, some UK residents will move to Spain, where they can be more comfortable. Before leaving, they have to sell their pound sterling and obtain the euro that can be spent in Spain. Selling the UK pound increases its supply and causes a fall in its value compared to the Spanish euro. Attractive investment opportunities. A country that has rewarding investment opportunities will always attract foreign investors. This will increase the demand for the country's currency and raise its value. This explains why countries with good economic opportunities tend to have relatively strong and stable currencies. The last factor is speculation. Currency speculators buy and sell currencies to make a profit from fluctuations in the exchange rates. If they expect the value of a particular currency to go down in the next few days, they will sell the currency now in order not to lose. This increases the supply of the currency and causes a fall in its value. Speculators study data about the economy which affect their expectation of the changes in currency value. Consequences of foreign exchange rate fluctuations. The fall or rise in exchange rate affects different groups such as exporters, importers, consumers, and producers. Depreciation or devaluation of the currency makes exports cheaper. Depreciation is a fall in the value of a currency as a result of demand or supply. Devaluation occurs when the government reduces the value of a currency. Both of them have the same effects. A fall in the value of a currency makes a country's exports cheaper to foreigners. Therefore, exports increase. One of the benefits of increased exports is more revenue for businesses that export their products. Also, taxes on exports increase government revenue. Selling more goods abroad requires more workers to produce, thereby reducing unemployment. Another benefit of more exports is that the economy experiences economic growth. Economic growth is an increase in the output of a country. Furthermore, if exports exceed imports, current account deficit will be reduced or eliminated. However, the increase in demand for a country's products abroad may cause total or aggregate demand to exceed total or aggregate supply. This will cause a rise in the prices of goods, which is referred to as demand pull inflation. What are the consequences of appreciation or revaluation? The exchange rate rises due to appreciation or revaluation. The difference is that appreciation is caused by market forces while revaluation is done by the government. When a country's currency appreciates, exports become expensive, which reduces the amount of exports. Export sales for businesses decline. Some workers may be laid off, and tax revenue declines. A country will experience a current account deficit if exports are less than imports. Less exports means the country is producing less. Therefore, economic growth is reduced. Appreciation or revaluation of a currency makes its value to rise in relation to other currencies. It makes exports expensive and imports cheaper. The prices of imported raw materials decrease, thereby reducing the cost of production. Lower cost of production reduces prices of products in the economy and, by extension, cost push inflation. Also, more importation of raw materials will increase production and cause economic growth. However, the country will experience a current account deficit if imports exceed exports. In addition, locally made products may not be able to compete with cheap imported products, which may cause the closure of domestic firms. We want to consider how the price elasticity of demand for exports and imports determine whether depreciation or devaluation will be effective in reducing current account deficit. A depreciation or devaluation will reduce export prices but increase import prices. Exports increase while imports decrease. Businesses will only make more export sales revenue if demand for exports is relatively elastic. If demand for exports is relatively elastic, a fall in export prices caused by depreciation or devaluation will produce a greater rise in the amount of exports. This will increase sales revenue because the rise in quantity sold is more than the fall in price. If imports have elastic demand, the quantity of imports will fall by a greater percentage following a rise in price caused by depreciation or devaluation. This is when depreciation or devaluation will correct current account deficit. Exports rise by a greater percentage and imports fall by a greater percentage. Fluctuations and macroeconomic objectives. Macroeconomic objectives are the targets or aims the government has for the whole economy. They include exchange rate stability, reduction of unemployment, economic growth, reducing inflation, and maintaining balance of payments equilibrium. We want to examine the relationship between exchange rate and other macroeconomic objectives. Firstly, depreciation or devaluation increases exports. If exports increase, more jobs will be created, thereby reducing unemployment. If the currency appreciates, exports become expensive and reduce. This will reduce output produced in the economy, causing a decrease in economic growth. Exchange rate fluctuation also affects inflation. If the currency depreciates, imported raw materials become expensive. This increases the cost of production and leads to cost-push inflation. Lastly, appreciation makes imports cheaper and exports expensive. Imports increase and exports decrease, causing a balance of payments deficit. What to do if a country has a strong exchange rate? If the exchange rate becomes strong, a country's export prices rise while import prices fall. The following measures can be used. Number 1. Sell price inelastic products. For price inelastic products, a rise in export prices will only cause a smaller fall in the quantity of exports, thereby increasing export revenue. Revenue falls if a country sells price-elastic products because the fall in export quantity outweighs the rise in export prices. Number 2. Cut the prices of exports to make them more affordable. Number 3. Increase productivity through workers' training, etc. This will reduce costs and prices of products. Number 4. Set up factories in overseas countries with lower costs since exporting is expensive. The goods will be produced and sold there, and there will be an inflow of money into the country. Number 5. Creating awareness or engaging in social responsibility abroad improves the visibility of a country's products and creates demand for them.